Most investors look at a financial chart and see a chaotic mess of green and red bars. But the elite few understand that. They are actually looking at a real-time map of human emotion, a visual battlefield where fear, greed, and indecision collide. You are likely losing money not because you lack a complex algorithm, but because you are trying to predict the future instead of reacting to the present. The promise of this psychological masterclass is the total elimination of guesswork. By learning to decode the price-action footprint left by the big banks and institutional players, you can stop being the liquidity for other people's trades and start moving in sync with the dominant market force. This fundamental shift from hoping to reading is the core principle found in Rainer Tier's definitive guide, Price Action Trading Secrets. It is not just a collection of strategies, it is a psychological blueprint for developing the discipline to ignore the noise and follow the only truth in the market, the price itself. To truly master the markets, you must first accept that a price chart is not a collection of random mathematical data points, but a living, breathing record of human psychology in its most raw form. Every tick up or down is a heartbeat of collective emotion, and Chapter 1 of Rainer Tier's philosophy demands that you learn to read these emotions through the lens of the 4 stages of market psychology. Most traders fail because they treat the market as a static entity. But the market is a cyclical repeating loop of accumulation, advancement, distribution, and decline. Understanding where you are in this cycle is the difference between being a predator in the market or becoming the liquidity that others feed upon. The cycle begins with the accumulation stage, which is perhaps the most difficult phase for the average trader to navigate. Psychologically, this is a period of profound boredom and uncertainty. After a long downtrend, the price stops falling and begins to move sideways in a range. To the untrained eye, the market looks dead, but behind the scenes, the smart money, institutional investors and professional traders is quietly and patiently building positions. They aren't chasing price. They are absorbing the supply left by frustrated, exhausted sellers who have finally given up hope. This stage is a test of patience. The psychological trap here is the breakout head fake, where the price briefly dips below support to flush out the last of the weak hands before the real move begins. If you lack the psychological stamina to sit through this sideways grind, you will likely miss the most explosive move of the cycle. Once the supply is fully absorbed, the market enters the advancing stage. This is where the psychology shifts from boredom to a mounting sense of urgency. As the price breaks out of the accumulation range and begins making higher highs and higher lows, the fear of missing out, or FOMO, starts to infect the masses. This stage is fueled by the latecomers, the retail traders who ignored the market during the accumulation phase but are now desperate to catch a piece of the action as they see the price climbing. This is the trend follower's paradise, but it is also a psychological minefield. The challenge here is not finding a trade, but managing the ego. As the price climbs, traders become overconfident, often increasing their position sizes at the exact moment the trend is reaching its climax. They mistake a rising tide for their own genius, failing to realize that the very momentum they are riding is being fueled by the desperation of others. As the trend matures, we enter the distribution stage. This is the mirror image of accumulation, but the underlying psychology is far more deceptive. The price begins to move sideways again, but the volatility increases. To the retail trader, these wild swings look like buying the dip opportunities, but in reality, they are seeing the smart money offloading their positions to the latecomers. The pros are selling their shares to the people who are just now hearing about the hot trend on social media or news outlets. Psychologically, this stage is characterized by cynical optimism. People want to believe the trend will go on forever, so they ignore the warning signs, the failed breakouts, and the increasing volume on downward moves. They are trapped in a cognitive bias, seeing only the information that confirms their hope while ignoring the reality that the big players have already left the building. Finally, the cycle concludes with the declining stage, the most painful and violent part of the psychological loop. When the distribution range finally breaks to the downside, the optimism of the previous stage evaporates instantly, replaced by sheer panic. This is where the liquidation cascade happens. Traders who bought at the top are forced to sell to protect what little capital they have left, and their selling drive the price down further, triggering the stop losses of others in a domino effect. The psychology here is one of absolute despair. People stop looking at their accounts because the pain of the loss is too great to face. They move from hoping for a bounce to just wanting it to end. Understanding these 4 stages allows you to detach your emotions from the immediate price action and see the market with the cold, detached perspective of a professional. You realize that you cannot control the market, but you can control your reaction to its current stage. You stop trying to be right and start trying to be in sync. When you recognize that the market is in the declining stage, you don't try to catch a falling knife out of ego. You wait for the signs of the next accumulation phase to begin. This is the ultimate strategic advantage, the ability to recognize that every period of pain in the market is simply the precursor to the next opportunity. By mastering the psychology of the cycle, you move from being a reactive participant to a proactive strategist, waiting for the herd to exhaust itself so you can move with the silent, disciplined force of the smart money. The pursuit of market mastery requires a fundamental shift in how you perceive the landscape of the chart, moving away from chasing the price of the moment and toward identifying the geometry of value. Most novice traders operate in a state of perpetual anxiety, reacting to every minor fluctuation as if it were a life or death emergency. They buy when the price is skyrocketing out of a sense of desperation and sell when it dips out of a sense of panic. Chapter 2 of Rayner-Tio's methodology is designed to kill this reactive impulse by introducing a disciplined search for the area of value. In the psychological theater of trading, the area of value represents the fair price where the tug-of-war between buyers and sellers reaches a point of historical significance. It is the only place on the chart where the risk-to-reward ratio actually tilts in your favor. To understand value, you must first master the psychology of support and resistance. These are not merely lines on a screen. They are the horizontal footprints of collective memory. Support is the level where, in the past, buyers felt the price was cheap enough to enter the market in mass, effectively creating a floor. Resistance is the ceiling where sellers felt the price was expensive enough to take profits or enter short positions. When the price approaches these levels again, the market participants remember the previous outcome. Buyers who missed the last bounce are waiting for a second chance to get in, and sellers who were trapped in a previous move are looking for an exit. This creates a self-fulfilling prophecy of price rejection. By waiting for the price to return to these historical battlegrounds, you are essentially letting the market prove its conviction to you before you risk a single dollar. However, the market is not always a clean, horizontal box. In a trending environment, value is dynamic, often represented by moving averages. Psychologically, a moving average such as the 20-period or 50-period MA acts as the mean or the average expectation of the market. When the price stretches too far away from the moving average, it is in a state of emotional overextension. Buying at this point is like buying at the peak of a fever. The price is overbought, and a mean reversion is almost inevitable. The professional trader waits for the price to pull back to the moving average, using it as a dynamic floor in an uptrend or a dynamic ceiling in a downtrend. This requires immense psychological restraint. It means watching a trend take off without you and having the discipline to say, "I will not chase this until it returns to a price that makes sense." The third geometric tool for defining value is the trend line. If support and resistance represent the market's memory of price, trend lines represent the market's memory of momentum. A trend line is a diagonal boundary that defines the slope of the market's current belief system. As long as the price stays above a rising trend line, the bullish psychology is intact. When the price touches that line, it is at a point of maximum value for a buyer because the stop loss can be placed just on the other side of the line, keeping the risk small while the potential reward remains large. Minding the trend line allows you to stay in sync with the dominant force without being distracted by the minor noise of daily volatility. The psychological core of identifying the area of value is the rejection of the middle. The middle of a range or the middle of a trend is a no. Man's land where the probability of success is essentially a coin flip. Novice traders live in the middle because they are afraid of being left behind. They see the price moving and feel they must do something. But the professional understands that trading is 90% waiting and 10% execution. By restricting your entries to the area of value, you are applying a filter that eliminates low probability trades. You are essentially telling the market, I am the house, and I only play when the odds are in my favor. Furthermore, this chapter highlights the importance of confluence, the psychological reinforcement that occurs when multiple value tools overlap. For example, if a horizontal support level aligns perfectly with a 50-period moving average and a trend line, you have found a high probability zone. This is where the different tribes of traders, the horizontal players, the trend followers, and the moving average users all agree to buy at the same time. This convergence of psychological intent creates a powerful floor that is difficult for the sellers to break ultimately. Mastering the geometry of value is about moving from a scarcity mindset to an abundance mindset. The scarcity mindset tells you that if you don't take this trade right now, you will never get another chance. The abundance mindset, fueled by the knowledge of the area of value, knows that the market is a revolving door of opportunities. If the price misses your value area, you let it go without regret, knowing that another setup is already forming. You are no longer a gambler hoping for a lucky break. You are a disciplined operator waiting for the market to reach the exact coordinates, where its psychological structure is most vulnerable. By the time you finish this chapter, you stop looking at what the price is and start looking at where the price should be. For you to care.